You'd think owning a data center is one of the safest bets in the modern economy. A tenant that needs your building more than you need them. A lease signed for 15 years. A waiting line of companies desperate for capacity, all fighting over a resource that can't be built fast enough. On paper, it looks like real estate had a baby with the internet, and the baby came out immortal. It isn't immortal. And the reason it isn't tells you almost everything about how this industry actually works. Who's really taking the risk, who's really getting paid, and why an asset class everyone describes as a sure thing keeps producing spectacular failures underneath the boom. Here's the pitch, the way it gets sold to investors, pension funds, and increasingly ordinary people through data center-focused funds. You buy or build a large industrial building. You fill it with racks of servers, either your own or a tenant's. A company like a cloud provider signs a long-term lease, sometimes 10 or 15 years, committing to pay whether or not they use all the space. Demand for that space is driven by something almost impossible to overstate, the shift of essentially the entire economy onto cloud computing, and now the explosion of artificial intelligence, which needs more computing power than anything that came before it. Global data center capital spending has been climbing into the hundreds of billions of dollars a year, with major technology companies individually committing tens of billions annually just to keep up. That's the story. Stable tenant, long contract, once-in-a-generation demand curve. It reads like the closest thing to guaranteed income the economy has left to offer.
The first problem with that story is what you're actually buying when you buy a data center. You assume you're buying a building, walls, a roof, a concrete pad, maybe some fancy cooling equipment. You're not. Not really. You're buying access to something you can't manufacture, can't expand on demand, and increasingly can't get at all without waiting years in line. Electricity. A modern AI-focused data center doesn't consume power like a warehouse or an office building. It consumes it like a small city. A single large campus built for AI training can require several hundred megawatts, and the biggest proposed sites now talk in gigawatts, the same scale of demand as a mid-sized metro area. That power has to come from somewhere, and somewhere is a grid that was mostly built for a world of gradual, predictable growth, not a handful of companies each asking for city-sized blocks of electricity within the same few years. To connect a large new power draw to the grid, a developer has to go through an interconnection queue, essentially a formal waiting list where utilities and grid operators study whether the local infrastructure can handle the new load without destabilizing everything else already plugged into it. In many regions of the United States, that study and approval process has been taking multiple years, sometimes stretching past 3 or 4, even for projects that already have land, permits, and assigned tenant. Land is cheap and plentiful. A guaranteed slot in an already strained power grid is not. This is the quiet reason so-called shovel-ready data center sites have become valuable almost independent of the building itself. What's actually being sold in many of these deals is the queue position.
That single fact rearranges the entire industry's incentives. Developers now chase land near existing substations and underused power plants, sometimes years before they have a tenant, because securing grid capacity is slower and scarcer than securing capital. Some companies have gone as far as contracting to keep aging power plants, including nuclear facilities, running longer than originally planned, specifically to guarantee themselves a private, dedicated supply of electricity outside the public grid queue entirely. When a company will pay a premium to keep a decades-old power plant alive rather than wait for a new grid connection, that tells you where the real bottleneck sits. It isn't compute, it's electrons. So the building looks like real estate, but the value underneath it is closer to a scarce commodity, right? Like owning water rights in a drought. That's the first crack in the safe landlord story. Here's the second one, and it's the crack that actually determines whether the money comes back. The equipment inside these buildings, the GPUs and specialized chips that do the actual computing, becomes obsolete fast. Useful economic life on this hardware is commonly estimated at somewhere in the range of 3 to 6 years before it's meaningfully outperformed by newer generations, and companies have been shortening the depreciation schedules they report to investors to reflect that reality. Compare that to the debt used to build the building around those chips, which is frequently structured to run 15, 20, even 25 years. You end up with an asset whose income-producing core needs to be replaced 4, 5, 6 times over the life of the loan that financed the building it sits in.
That mismatch is the real character of this asset class, and it's the opposite of what the safe real estate pitch implies.
A well-built office tower, absent some external shock, tends to hold or gain value over decades because the thing generating the income, office space, doesn't functionally expire. A data center's income-generating core does expire, on a clock measured in years, not decades. Economically, a data center behaves less like an office building and more like an airline's fleet of jets, a physical shell wrapped around fast depreciating high-maintenance equipment that has to be replaced on a predictable schedule just to stay competitive, financed with debt that assumes a much longer, steadier life than the equipment inside actually has. That mismatch would be a manageable, well-understood risk if it were the only one. It isn't, because of who's actually putting up the money to build these things now and what happens if a tenant doesn't renew. Here's a detail that rarely makes it into the coverage of the AI data center boom. An enormous amount of this construction isn't funded directly by the household names using the buildings. It's funded through special-purpose financing vehicles, often backed by private credit funds and insurance company balance sheets, that lend against the strength of a long-term lease from a large tenant. On the surface, that sounds reassuring. A top-tier company's name is on the contract. But the actual credit exposure often sits 1 or 2 steps removed from that company, inside a legal structure built specifically so the debt doesn't appear on the tenant's own balance sheet, and so the lender's real recourse, if something goes wrong, is the building and the lease, not the tenant's broader corporate guarantee. Rating agencies and financial researchers have flagged this structure as a growing source of hidden leverage in the financial system, precisely because so much of it sits outside traditional bank balance sheets, in places with less transparency and less regulatory scrutiny.
Now walk the full chain of what has to go right for one of these projects to work, and you'll see how a single weak link travels through the entire structure. A hyperscale cloud company signs a long-term lease for a facility custom-built to its power and cooling specifications. That lease gets used as the collateral to raise non-recourse debt where the lender's claim is limited to the project itself. That debt funds a highly leveraged construction process, often for a building engineered around the exact power density and cooling requirements of one specific generation of chips. The chips arrive, the facility goes live, income starts flowing, everyone looks smart. 3 to 6 years pass. The chips are now outdated. If the tenant's business still needs that much capacity and next-generation chips can be retrofitted into the existing power and cooling envelope, the lease renews and nothing outwardly changes. But if AI demand growth slows, if a competitor's newer facility is more efficient, or if the next generation of chips needs a fundamentally different power density than the building was designed for, the tenant has real leverage to walk, renegotiate sharply downward, or simply not renew.
And this is where the building's biggest apparent strength, its specialization, turns into its biggest weakness. A facility engineered around extreme power density and industrial-scale cooling for one specific use isn't easily converted into something else. It's not like an empty office floor that can be relet to almost any business for almost any purpose. It's a purpose-built industrial asset. If the anchor tenant leaves, the pool of replacement tenants who need that exact specification in that exact location with that exact power capacity can be small or non-existent, especially outside a handful of markets that already have grid capacity. The debt, structured for 15 or 20 years of assumed steady income, suddenly has to be refinanced against an asset that may be worth meaningfully less than the day it was built. And because so much of this lending sits in private credit funds and insurance portfolios rather than heavily regulated banks, the losses don't necessarily show up quickly or transparently. They surface later in fund valuations and insurer balance sheets in ways that are harder for markets to see coming. None of this is hypothetical as a pattern. The industry has lived through a version of exactly this story before, and the case is well documented enough to be worth walking through in full.
In the late 1990s, a company called Exodus Communications became the poster child of the first data center boom. Exodus built massive, purpose-designed facilities to host the servers of the exploding number of internet companies that didn't want to run their own infrastructure. It went public in 1998, and as dot-com mania accelerated, its stock and reputation soared along with it. At its peak, Exodus was valued by the market in the tens of billions of dollars, a company built almost entirely on the bet that internet infrastructure demand would keep compounding indefinitely. It signed marquee customers, expanded aggressively into new facilities across the country and internationally,
and was widely treated as one of the safest ways to invest in the internet boom without picking which individual .com would win. Because Exodus, the thinking went, would get paid no matter who won. The first warning sign wasn't a dramatic one. It was quieter. Many of Exodus's fastest-growing customers were themselves unprofitable .com startups burning through venture capital, paying for expensive hosting contracts with money that had nowhere else productive to go. When the .com funding environment turned in 2000, those customers didn't gradually slow down. Many of them failed outright, all around the same time, which meant Exodus lost real, paying tenants in a wave rather than a trickle. Revenue that had looked like a stable, diversified base turned out to be far more concentrated in fragile companies than the growth numbers had suggested. At the same time, Exodus had been building capacity aggressively, financed with substantial debt, on the assumption that demand would keep expanding to fill it. When that assumption broke, the company was left holding enormous fixed costs and debt obligations against a customer base that was evaporating. Exodus filed for bankruptcy in September 2001, and its assets were eventually acquired out of that process by Cable and Wireless for a fraction of what the company had once been worth at its peak. What that case proves isn't that data centers are a bad business. Internet infrastructure demand on the multi-decade timeline kept growing exactly as Exodus originally bet it would. Cloud computing, streaming, and now AI are all descendants of the demand Exodus saw coming. What it proves is that being right about the long-term trend doesn't protect you from being wrong about the financing structure, the concentration of your tenant base, and the pace at which you built ahead of confirmed, durable demand. The trend can be real, and the specific bet can still fail if too much leverage is layered onto assumptions about a growth rate that has to hold steady for the debt to work. The industry that rebuilt itself after that collapse absorbed some of that lesson, though not all of it. Co-location providers, companies that rent out data center space to many smaller tenants rather than betting on one giant customer, became a way to diversify tenant risk instead of concentrating it. Hyperscale cloud companies increasingly began building and owning more of their own critical infrastructure directly rather than relying entirely on third-party landlords, partly to control exactly this kind of counterparty risk. Site selection shifted to prioritize power access and grid queue position as heavily as land cost, and facility design moved toward more modular, upgradable layouts, specifically so that a building doesn't become obsolete every time the chips inside it do. But the core structural tension never went away. It just changed shape. Today's version isn't unprofitable .com tenants. It's the question of whether AI compute demand keeps compounding at the pace current construction assumes, or whether it plateaus once companies work out how much AI capacity they actually need versus how much they race to secure out of fear of being left behind. Industry analysts and even some technology executives have publicly raised the possibility that current AI infrastructure spending could outpace near-term revenue from AI products, at least for a period. Not because AI itself isn't real or valuable, but because building physical infrastructure happens in large, lumpy, multi-year commitments, while actual usage and revenue tend to grow in a messier, less predictable line. So what does the honest range of outcomes actually look like? In the optimistic case, AI demand keeps climbing roughly in line with current build-out plans. Tenants renew and upgrade in place rather than walking away. Power constraints ease gradually as new generation and transmission capacity comes online, and today's facilities age gracefully into the next generation of chips. Owners and lenders get paid roughly as modeled, and the industry looks, in hindsight, like an accurate bet on a durable trend, much like the internet infrastructure build-out eventually was, decades later than the original investors expected. In the realistic negative case, demand growth decelerates, or specific companies overbuild relative to their own actual needs. Some facilities built for one generation of hardware can't be cost-effectively retrofitted for the next. Tenants renegotiate leases downward or exit at renewal, and the losses land disproportionately on the private credit funds and insurance portfolios that financed the leveraged construction. Visible not as one dramatic bankruptcy, but as a slow series of impairments and refinancing struggles spread across a less transparent corner of the financial system. The realistic middle case, which is what usually actually happens in booms like this, is some mix of both. The overall trend proves directionally correct, but a meaningful number of individual projects, the ones built on the most aggressive assumptions, the thinnest tenant diversification, or the weakest power positions, don't survive the transition to prove it.
So go back to the opening idea that owning a data center is basically real estate with a technology theme. A safe landlord's income stream backed by an unstoppable demand curve. That description was never quite true, and now you can see exactly where it breaks. The building is real, but the building isn't what you're really buying or really betting on. You're betting on continuous access to electricity that the grid can't yet reliably promise anyone at this scale. You're betting that the tenant's need for this exact facility outlasts the useful life of the chips inside it. And you're betting that whoever actually financed the leveraged gap between those two things, often a private credit fund or an insurer you'll never see named in the marketing materials, gets their assumptions right about a technology curve that has fooled nearly everyone who's tried to predict it before. A data center isn't a building that happens to hold computers. It's a bet on someone else's obsolescence curve, dressed up in the language of real estate. And how that bet pays off has far less to do with concrete and steel than with a power line, a grid queue, and a tenant who has every incentive in 3 to 6 years to want something newer.